Hello, and welcome to Technology News for October 16, 2013. Apple officially sets its October 22nd iPad event as expected. Apple sends out invitations for an event early next week where it will likely introduce new iPads and Macs. By Josh Lowenson. CNET. Apple's very busy fall season of product launches is in full swing. The company just sent out invites for a news event next week, where new iPads and Macs are expected. The invite says only, "We still have a lot to cover," and has colorful leaves from the Apple logo. The press conference will take place at Yerba Buena Center for the Arts Theater in San Francisco, and begins at 10 a.m. Pacific. CNET will be there to bring you all the news, live. Stay tuned for more details on how to watch. Apple's last event was in September, where the company debuted the iPhone 5S and 5C, which went on sale a week later. This time around we're expecting new models of the iPad and iPad mini, which have been chronicled in a series of leaks. Apple is also expected to update some of its Macs, particularly its MacBook Pros, and offer a price and release date for OS X Mavericks, which was first shown off in June and finalized earlier this month. The date matches up with one reported earlier from Althingst. Apple's chief financial officer characterized the company's fall as very busy while talking to Wall Street analysts earlier this year. So far it's gone with a very similar strategy to last year, with two main events just before the busy holiday shopping season to refresh its entire product line. However, CEO Tim Cook has hinted that there are some big products slated for early next year too. It's unclear at this point if Apple will also be offering a live video stream for the event. The company provided one for last October's event, which brought a new version of the full-size iPad, as well as the debut of the iPad mini and upgrades to some Macs. CNET will have more details on what's expected, as well as how to watch next week's event in the coming days. Next story. Yahoo's 3Q results drop along with AD prices. By Michael Liedtke. AP Technology Writer. San Francisco. AP. Yahoo is regaining its appeal among investors a lot faster than with the online advertisers who generate most of its revenue. The internet company's third-quarter numbers released Tuesday are the latest to underscore the challenges facing CEO Marissa Mayer even as Yahoo's stock continues to soar under her leadership. The shares have more than doubled since Yahoo lured Mayer away from rival Google Incorporated 15 months ago, largely because investors prize Yahoo's 24% stake in Chinese internet star Alibaba Group Holding. Alibaba is already making far more money than Yahoo while growing at a rapid pace that bodes well for the future. Yahoo is leaning on Alibaba and another investment in Yahoo Japan for most of its income, a trend highlighted again in the latest quarter. Yahoo Incorporated, meanwhile, is still struggling to revive its revenue growth even though marketers are spending more on online ads. Most of that money, though, is flowing to search leader Google and social networking frontrunner Facebook Incorporated. Both of those companies have built addictive services and networks that have proven to be more effective marketing vehicles. After subtracting the commissions paid to its partners, Yahoo's ad revenue during the 3 months ending in September dipped by 2% from the same time last year. "It was a pretty dismal quarter," said BGC financial analyst Colin Gillis. They are very fortunate to have Alibaba. A change in the way Yahoo will eventually have to sell its Alibaba holdings seemed to please investors. Under a new arrangement announced Tuesday, Yahoo will now be required to sell 208 million of its Alibaba shares in an IPO widely expected to occur next year. That's down from 261.5 million under a deal reached 17 months ago. The revised terms will be a boon for Yahoo if Alibaba's stock soars above its IPO price, as often happens with promising technology stocks. Yahoo's stock gained 26 cents to $33.64 in extended trading after Tuesday's news came out. Mayer, 38, is pleading for patience to get Yahoo's own business in better shape, saying it may take another year or two before Yahoo's sales are growing at the same rate as the overall market. In the first half of this year, internet ad spending climbed 18% from the same period in 2012. In an online video presentation Tuesday, Mayer sought to shift the focus to signs that web surfers are relishing the changes she has been making to Yahoo's products. Her revisions are an attempt to bring in more people on mobile devices and persuade them to stick around for longer periods of time. She said the number of digital pages on Yahoo's services is now back to the levels of 2 years ago and predicted ad spending will eventually rebound, too. I am more encouraged than ever in Yahoo's potential for growth in both the near and long term, Mayer said. It will take some time for increased engagement to translate into revenue, but I'm confident we are on the right track. Mayer's optimism couldn't mask the third quarter declines in both of Yahoo's advertising categories. The Sunnyvale, California company sold fewer display ads at lower prices in the quarter, and the amount of money marketers paid for the text ads next to Yahoo's search results declined even as those ads drew more clicks. Yahoo earned $297 million, or 28 cents per share, in the 3 months ending in September. That's 91% drop from nearly $3.2 billion, or $2.64 per share, during the same period a year ago. It wasn't an apples-to-apples comparison because last year's profit was lifted by a $2.8 billion windfall from Yahoo's sale of nearly half its Alibaba stake. If not for certain items unrelated to its ongoing business, Yahoo said it would have earned $358 million, or 34 cents per share. That per-share figure was a penny above the average estimate among analysts surveyed by FactSet. Revenue fell 5% from last year to $1.1 billion. After subtracting ad commissions, Yahoo's revenue stood at $1.08 million to match analyst projections. The company expects its revenue, minus commissions, to range from $1.18 billion to $1.22 billion in the current quarter ending in December. Analysts had been anticipating revenue of $1.25 billion. Next story. Intel 3Q profit unchanged, but beats predictions. By Bree Fowler. AP Technology Writer. New York. AP. Intel said Tuesday that its third quarter net income was unchanged, stymied by a continued slump in global PC demand. The chipmaker earned $2.95 billion, or 58 cents per share, compared with $2.97 billion, or 58 cents per share, in the same quarter of 2012. Revenue also was unchanged at about $13.5 billion. The drop in PC-related sales came amid another decline in PC shipments. Intel supplies chips for about 4 out of every 5 PCs. The rest come from Advanced Micro Devices Incorporated, which reports financial results on Thursday. IDC said last week that worldwide PC shipments fell nearly 8% during the third quarter, to 81.6 million, while fellow market research firm Gartner Incorporated put the decline at almost 9%, to 80.3 million. The two firms define PC slightly differently. The drop marked the 6th straight quarter of decline for the industry, as computer makers, and the companies that supply them, try to reshape themselves amid the continued shift toward tablets and smartphones. Intel CEO Brian Krzanich said on a conference call with investors that while consumer demand in emerging markets was sluggish during the recent quarter, the company started to see early signs of improvement in North America and Western Europe. He attributed that to the company's growing product lineup. Intel's results for the quarter, which ended September 28, beat Wall Street predictions. Analysts polled by FactSet expected a profit of 53 cents per share on revenue of $13.4 billion. Revenue at the company's personal computer business fell 3.5% to $8.4 billion because of a drop in the number of chips sold, while data center revenue increased 12% to $2.9 billion, helped by both higher prices and higher volumes. For the fourth quarter, Intel projected revenue of $13.2 billion to $14.2 billion. Analysts were looking for $14 billion. Shares of Santa Clara, California-based Intel Corporation fell 59 cents, or 2.5%, to $22.80 in extended trading after the release of results. Next story. Twitter's losses mount ahead of IPO. New York. AP. Twitter's losses are mounting as the online messaging service prepares to make its stock market debut. A regulatory filing Tuesday disclosed the San Francisco company lost nearly $65 million during the 3 months ending in September. That's the largest quarterly setback that Twitter has suffered during the past 3 years. Twitter lost about $22 million at the same time last year. In a development likely to hearten prospective investors, Twitter's revenue more than doubled from last year to nearly $169 million. But the company's rising losses could dampen some of the enthusiasm for Twitter's initial public offering. The IPO is expected to be completed next month, though the company hasn't set a target date. Twitter ended September with 232 million active users, up from 218 million in June. This is a breaking news update. Check back soon for further information. AP's earlier story is below. The New York Stock Exchange has beaten its tech-heavy rival in the quest for the biggest stock debut of the year. Twitter said Tuesday it will list its shares on the NYSE when the company goes public later this year, choosing it over the traditionally tech-friendly Nasdaq Stock Exchange. The microblogging service did not say in the regulatory filing when it expects to start trading, but the debut is expected before Thanksgiving. It will use the ticker symbol TWTR. The news is an upset for the Nasdaq, which has traditionally been the place for technology IPOs. The exchange was looking to redeem itself after last year's Facebook's IPO, which was marred by trading order failures and delays. As a result, the Securities and Exchange Commission in May fined the exchange $10 million, the largest ever levied against an exchange. Both exchanges had courted San Francisco-based Twitter heavily. The NYSE has wooed a growing list of companies recently, including 10 of the 20 largest technology IPOs so far this year, according to research firm Dealogic. Winning an IPO is always a big deal for an exchange, but a high-profile name like Twitter is an especially coveted prize. As long as Twitter's IPO goes well, it should give the NYSE an edge in luring other IPOs, particularly in the fertile area of social media. We are grateful for Twitter's confidence in our platform and look forward to partnering with them, said NYSE spokeswoman Marissa Arnold in a statement. A Twitter spokesman declined to comment beyond the announcement. Next story. Sony's $200 smartwatch works with Android phones. By Anik Stonan. AP Technology Writer. New York. AP. Sony says its new computerized wristwatch will sell for $200 in the US and will work with a variety of Android phones. Sony's smartwatch 2 hasn't gotten as much attention as Samsung Electronics Company's Galaxy Gear, but it's cheaper and compatible with a broader range of phones. The Gear costs $300 and currently works only with the company's Galaxy Note 3 phone. Unlike the Gear, however, Sony's watch doesn't let you make phone calls directly through the wristwatch. You can answer calls using the watch, but you need a Bluetooth wireless headset linked to the phone if you don't want to hold it to your ear. Sony Corporation said Tuesday that the watch is available immediately through the company's physical and online stores. Other online retailers will also sell it. As more people own smartphones and tablets, consumer electronics companies are creating a new category of products to give consumers more ways to stay connected and to spend money. Qualcomm Incorporated also plans to release a smartwatch in time for the holidays, while Apple is widely believed to be developing an iWatch. The company said its smartwatch is designed to perform common tasks such as checking texts and email, liking Facebook posts and getting calendar reminders. Reply capabilities will be limited. You can respond to a text from a list of emote icons or preset messages, for instance. The average smartphone user reaches for their device more than 100 times per day to check text messages, read emails and social network notifications and of course, to check the time, Ravi Nakala, U.S. President of Sony Mobile Communications, said in a statement. Smartwatch 2 makes these core tasks easier, and does much more with apps available, for everything from productivity to fitness and games. Smartwatch 2 is designed to complement a phone, specifically those running Android 4.0 or later. Sony promises 3 to 4 days of battery life between charges, compared with about a day for the Gear. The display measures 1.6 inches diagonally, the same as the Gear. Separately, Sony announced the US availability of 2 new phones. The Xperia Z Ultra is a larger version of its Xperia Z waterproof smartphone. It has a 6.4-inch screen, among the largest out there. A standard version will retail for $650, while a faster, 4G LTE version will sell for $680. The Xperia Z1 is a 5-inch phone that sports a massive 20.7-megapixel camera and is capable of attaching better lenses. That retails for $670. The phones won't be locked to a specific wireless carrier, but they won't work with Verizon or Sprint's network. Sony did not announce plans for locked, subsidized versions that require 2-year service agreements. Next story. iPhone 5C may flourish despite slow start. By Rochelle Dragani. Mac News World. The iPhone 5 seconds may be outselling the candy-colored iPhone 5C 2-to-1 or perhaps even 3-to-1, and Apple may be cutting production in half, but it's still too soon to call the 5C a failure, suggested Creative Strategies' Ben Badgerin. It could be that the company is learning which colors 5C consumers want and is creating a more efficient supply chain. Rush, planning for increased traffic for this holiday season? Things Remembered. Chia, Mark Lillian and Compuware share best practices on how to prepare for the challenge of increased holiday traffic during the biggest online shopping season of the year. Free Binary October 17th. Register today. Apple's latest version of its flagship smartphone, the iPhone 5 seconds, is outselling the company's mid-tier iPhone 5C at a rate of 2-to-1, according to an Althings report citing statistics from consumer intelligence research partners. Apple's simultaneous launch of 2 iPhone models was a first for the company, so there was no basis for gauging consumer reactions. It now appears the 5 seconds is far more popular. Although SERP data suggests it is outselling the 5C at a rate of 2-to-1, a report from Mixpanel, which measures global metrics, estimates that the margin worldwide is closer to 3-to-1. The higher-end smartphone has accounted for 64% of total iPhone sales since it launched, reported SERP, while the 5C accounted for 27%. The iPhone 4S took the remaining 9%. The iPhone 5 seconds had a slightly less successful launch than the iPhone 5 did, based on the data, with the 5 seconds snagging 64% of new sales in the smartphone market following its release, compared to the 68% that the iPhone 5 claimed. The SERP news followed a weekend report from Chinese website C Technology suggesting that Apple would be having daily production of the 5C, producing 150,000 units per day, down from 300,000. Apple did not respond to our request to comment for this story. Disappointing launch? One reason Apple decided to launch the colorful, $99 iPhone 5C was to appeal to consumers in emerging markets or those who hadn't previously been able to afford an iPhone, noted John Felland, CEO and founder of Argus Insights. However, the iPhone 5C might not be charging into new markets as quickly as Apple had hoped. While the target market is now worldwide, samplings of consumer demand in the US, UK and China show that the iPhone 5 seconds far outperforms the iPhone 5C, indicating that demand for the colorful 5C is much lower worldwide than experts expected, Felland told McNews World. No panicking yet. Although sales appear to be starting off slower than expected, that doesn't mean those additional markets won't open for the 5C going forward, said Colin Gibbs, analyst at GiganPro. High-profile devices like Apple's high-end iPhone tend to do well out of the gate because those are the kind of phones tech-savvy consumers hold out for, he told McNews World. So I'm not at all surprised that the iPhone 5 seconds is outselling the iPhone 5C by a considerable margin, but I expect that gap to narrow in the coming months. Even if the reports of cutting back on 5C production are true, it could be for reasons that favor Apple, said Ben Badgerin, director and founder of Creative Strategies. It could be that the company is learning which colors 5C consumers want and is creating a more efficient supply chain. It also could be welcome news that the cheaper 5C is not cannibalizing production of the company's higher-end signature device. The report of them cutting 5C orders is a basic inventory reshuffling, Badran told McNewsWorld. Cutting back on some colors which didn't have the pull would not be surprising. Part of the cutting back could also be to beef up on meeting supply for the 5 seconds, which perhaps had more demand than even they anticipated. Next story. Netflix is thinking inside the cable box. By Peter Sushu. E-commerce Times. Netflix will no longer be confined to the net if the latest rumors materialize. It seems it wants to morph into something more like HBO, complete with a spot on cable company set-top boxes. Netflix sees itself as a complement, not a competitor, to the existing pay TV market even if they are currently siphoning off customers, remarked Greg Skublit, analyst for Digital Tech Consulting. Netflix may be angling to provide streaming content to cable subscribers, based on a report in Monday's Wall Street Journal. It appears Netflix is exploring deals with Comcast and Suddenlink Communications to launch an app for set-top boxes. Netflix shares rose 5% in early trading on the news. Netflix streams its content through web-connected TVs, media players such as Apple TV and Roku, video game consoles from Microsoft, Nintendo and Sony, and many Blu-ray players. About the only boxes that aren't served by Netflix are those from the cable and satellite providers. What stands in the way is the technology that improves how video is streamed. Getting on the box. Cable operators in the United States could be interested in bringing Netflix's original content, including the Emmy-nominated series House of Cards, to their viewers. As Netflix boosts its courts as a content creator, cable operators may be interested in using its offerings to help retain viewers. This is already an approach Netflix has taken in the past with international cable providers, including with Virgin Media in the UK and Comhem in Sweden. Colin Dixon, founder and principal analyst at NSCREN Media, told the E-commerce Times. In those deals, Netflix had integrated with TiVo and the cable providers, added Dixon. They reached a deal to bring the Netflix client to show up on the box. Everything runs happily on that platform, so it isn't hard to see that they could do the same thing in the United States. Going premium. Such a deal also could allow Netflix to become a premium channel of sorts and thus compete with the likes of HBO, Showtime and Starz. Netflix sees itself as the next HBO that is, a complement, not a competitor, to the existing pay TV market even if they are currently siphoning off customers from the existing pay TV players, said Greg Skublit, analyst for Digital Tech Consulting. This lets Netflix preserve their experience on demand viewing, great user interface but with the added benefit of tapping into the wider pay TV audience, he explained. They are looking to go the premium route, but they could be a completely on-demand, suggested Eric Brannan, senior analyst for U.S. television market at Sci-Supply. This would be much like how the cable channels work with VOD, video on demand, offerings, he pointed out. The question is what type of deal there is, and there are a few ways it could go down, Brannan told the E-commerce Times. The traditional premium deal, such as what HBO and Comcast have, is a 50-50 split. The question becomes how Netflix, which is getting us $8 a month from 29 million subscribers, is going to make a deal work to get more subscriptions, but is it worth it at $4 for each one? Challenges remain. It might not be as easy as simply flipping a switch and becoming a new channel, either. The challenge is that many of the operator boxes are just not good enough to run the Netflix client on those boxes, so it could be limited to the boxes that are connected or connectable via a DVR, noted Dixon. There is a chance, slim but still a chance, to get on all the set-top boxes, but to do it would be very difficult, he noted. In this case, consumers wouldn't be watching Netflix over the internet but would watch it over cable as they do with VOD, Dixon added. It would work something like that. It is possible to do but logistically difficult. Value add for customers. How Netflix can make any money on the deal is problematic, especially if its service is offered to subscribers for $8 a month. It could be a pay-per-view model, but how do you get customers to pay more than the $8 they could pay to get Netflix through their TV or Blu-ray player? Even if customers just want a particular show, it seems it would be cheaper to pay for the month. It is hard to figure out why people would be interested, observed Dixon. There are significant programming deals that Netflix has made, and they are clearly looking for ways to maximize them, added Brennan. However, with the demands for content freshness and exclusivity, any strategy it comes up with could be hard to maintain, he said. Another possibility is that Netflix's offerings could be grouped in with paid TV bundles, so subscribers to premium packages could get the Netflix content either same day or delayed for weeks or a month. Would Netflix want such a deal? If I was Netflix, I wouldn't do that deal, said Dixon, as it takes away the reason to have Netflix, said Dixon. This is the end of Technology News Stories. Thank you for listening.